Welcome to Finsights Daily by Finvestin, where we cover the daily updates from the world of finance that impacts your day-to-day life. I'm your host Narendran. Quick reminder, play this episode at 1.5x for a better experience if you are short on time. In today's episode, we're going to see three investment options that are going through a churn in India. First, stock markets nosedive due to tariff wars. Second, gold taking a surprising turn. And finally, a good news about the real estate market in major cities across India. Let's dive into the first segment. Stock market taking a roller coaster ride in on a Monday morning. Today, the Indian stock markets experienced a significant downturn. The Nifty 50 index fell by 3.24%, closing at 22,161, while the BSE Sensex dropped by 2.95%, ending at 73,137. Marks one of the most substantial single day declines in recent months. Let's understand the causes. The primary driver behind this sharp decline is the escalating global trade tensions that's we have been discussing for the past 1 week. President Donald Trump has imposed 26% tariff on India in addition to baseline duty of 10% applicable to all countries. These actions have sparked fears of a global trade war leading to widespread uncertainty among investors, and this had a global impact. The repercussions of these tariffs are not confined to India. Major global indices have suffered this. Japan's stock index Nikkei has also fell by 7.81%, and Hong Kong's Hang Seng index plunged to 13.2%, marking a worst day since 1997. And Germany's DAX index dropped 5.3%, and UK's FTSE 100 fell by 4.1%. This also applies to our all sectors' performance in India. Within Indian markets, all 13 major sectors witnessed declines. Notably, IT index, the Nifty IT index declined 2.5%, and metals dropped by 6.75%, and Nifty Financial Services index fell by 3.5%. The heightened trade tensions have led to increased market volatility. The Nifty Volatility Index, that is weeks by 66%, marking its largest single session increase in 10 years. This surge indicates a significant rise in investor anxiety and uncertainty regarding future market movements. In response to the US tariffs, the Indian government has stated that it is studying the impact of the 27% tariff imposed by ESA and has vowed to push for a trade deal this year. This approach indicates a focus on negotiation rather than immediate retaliation. Market corrections of this magnitude, whilst unsettling, are not unprecedented. For long term investors, such downturns can present opportunities to acquire quality stocks at reduced prices. However, it's crucial to conduct thorough research and consider one's risk tolerance before making investment decisions. Diversifying portfolios and focusing on fundamentally strong companies can help navigate through periods of highest market volatility. In conclusion to this segment, while the market scenario is challenging, maintaining a long term perspective and staying informed can aid investors in making prudent decisions during these turbulent times. Next, we're going to see gold taking a surprising turn in this market. Let's move to gold now. Normally, when stock markets crash, gold prices go up. That's because gold is seen as a safe investment option during these kind of tough times. But strangely, this time gold prices are also going down. So, what's going on? Analysts say there are few reasons. One, strong US dollar. When the US dollar strengthens, gold becomes more expensive in other countries, and other countries' people prefer less buying this gold. And second, rising interest rates in the US. High interest rates make other investments like bonds more attractive than gold, which doesn't give any returns. And third, a change in investment behavior. Some big investors are now treating gold more like a trading asset rather than a long term safe haven. If you are wondering what to do with your gold investments, stay calm. Gold is still a good asset to hold for the long term. It protects your portfolio during inflation and currency issues. But don't try to time the market. Instead, invest in gold gradually, maybe through SIPs in gold mutual funds or digital gold, and keep it as a part of your long term financial plan. For a deeper dive into gold investing, check out our earlier episode on Gold Rush. Is the glitter worth your investment? Before diving into the real estate market, let's look at the economic backdrop for this. Despite global volatility, India continues to show remarkable resilience. The RBI projects 6.5% growth for financial year 2025 and 6.7% for financial year 2026, still among the highest globally. The central bank has reduced policy rates for the first time since 2020 by 25 basis points and expected another rate cut in this week. This comes with consumer inflation dropping to 3.6% in the Q1, that is quarter 1 of 2025. With RBI's initiatives to increase liquidity in the banking system, we expect improved credit availability at reduced interest rates for home buyers throughout 2025. This stable economic foundation has powered significant activity in both office and residential real estate markets. Let's look into the report statistics and data. The residential market stayed stable in the Q1 of 2025 with a marginal 2% year-on-year growth, totaling 88,274 units across 8 major cities. Mumbai leads with nearly 25,000 units sold, up 5% from last year. Pune and Chennai were the best performers, with sales growing by 20% and 10% respectively. However, NCR and Bengaluru saw sales decline by 8% and 5%, while simultaneously recording the highest price increases 12% in NCR and 16% in Bangalore. Developers launched 96,309 units in this quarter, a 3% growth over last year. Mumbai and Bengaluru led in new launches, accounting for 44% of all new units. While unsold inventory increased by 5%, the quarters to sell ratio remained stable at 5.9 months, indicating a balanced market overall. The most significant trend is continued premiumization. Properties priced at 1 crore plus and above now constitute 46% of sales, up from 40% a year ago. The 2 crore to 5 crore segment has now grown from 12% to 16% market share, with sales volume increasing by 28% year on year. Meanwhile, affordable segments under 1 crore have seen sales drop by 6 to 9%, pointing to a clear shift in developer focus towards premium projects. Now, let us look at the commercial office space market. In this, it showed extraordinary momentum, with transaction volumes hitting a record 2.62 million square meters in Q1, a massive 74% growth year on year. Bengaluru, as always expected, set a new record with 1.18 million square meters of space taken up, accounting for 45% of all transactions. Mumbai and Pune also reached record highs, while Hyderabad achieved its highest post pandemic levels. The global capability centers were the biggest consumers of office space at 44% of all transactions, with 65% of GCC deals concentrated in Bengaluru. Third party IT services firms made a significant comeback, taking up 19% of the total area compared to 9% a year ago, suggesting India's growing attractiveness as an IT services destination in the AI era. With demand outpacing new construction, vacancy levels have decreased to 14.3%, down from 17.2% in 2021. This supply squeeze has pushed rents higher across all markets, with Hyderabad and Kolkata seeing a highest growth of 9% year on year. And for home buyers, the market presents varied opportunities. Premium properties seekers will find plenty of options but higher prices. Cities like Pune and Chennai offer better value with strong sales momentum, while affordable housing faces challenges with limited new supply and rising prices. For investors, premium and luxury segments present attractive opportunities with strong demand and price appreciation. Commercial real estate, particularly in Bengaluru, Mumbai, and Pune, offers strong investment prospects given the record demand and limited new supply. Looking at specific cities, Bengaluru stands out in commercial spaces but faces pricing pressures in residential. Mumbai remains strong across both segments as always. Pune offers good value with strong growth in both residential and commercial sectors. The reduced interest rates and increased liquidity measures should gradually improve affordability, particularly in the mid range segments, making strategic timing on important considerations for both home buyers and investors in the coming quarters. Well, that's all for today's Finsights Daily. Thank you for joining me. This is Naren signing off. I'll see you in the next episode with fresh updates from the financial world. Have a wonderful evening and remember, stay financially savvy.